Welcome back to the deep dive. For you, the learner, navigating this space means, well, looking past all the hype and basically just following the money.
Oh, absolutely. Always follow the money.
Right. Because right now, the greatest bottleneck to artificial intelligence isn't software. It's actually physics.
Yeah, it's a physical problem, not a code problem.
Exactly. I mean, we think of the cloud as this invisible, weightless thing, right? But it is actually made of silicon and light. And the company's figuring out how to, physically push that light through fiber optic cables faster. They're quietly printing millions of dollars.
Millions. I mean, it's a total gold rush.
It really is. So today, we are opening up a stack of financial documents for MaxLinear. We've got their Q1 2026 earnings presentation, their official press release, and, of course, the notoriously dry SEC Form 10Q filing.
Oh, yeah, the 10Q. Always a fun read.
Always. But our mission here is to decode these documents, right? We want to uncover like a master class in how a hardware business pivots its entire identity to capitalize on this massive data center boom.
Yeah, and it's a dramatic pivot for sure.
It really is. Okay, let's unpack this, because before we can understand the futuristic hardware MaxLinear is building, we have to look at their scoreboard. And the financial results present this massive, massive contradiction.
Yeah, I mean, the top line and the bottom line are just telling two completely different stories, like entirely different.
Right.
So for Q1 2026, their net revenue sits at $137.2 million.
Which is huge.
Yeah, that is a 43% jump from Q1 of 2025. I mean, a hardware company seeing a 43% year-over-year revenue increase, that demonstrates serious, undeniable momentum.
Yeah, you can't fake 43% growth.
Exactly. But the moment you look for the actual profit, the narrative just kind of fractures.
Yeah, because I'm looking at two different sets of accounting rules in this presentation, and they yield completely opposite realities.
Right.
If we use GAAP, which is, generally accepted accounting principles, the strict, heavily regulated rules every company has to follow MaxLinear shows a diluted earnings per share loss of 52 cents.
Yeah, it's a very significant loss.
Right, that translates to a net loss of over $45 million just for the quarter. But right next to that, they report their non-GAAP numbers, which is, management's customized view of the business. By that metric, they have a positive diluted earnings per share of 22 cents.
Yeah.
Which is a $19.4 million profit.
Yeah.
So it really begs the question, are they bleeding cash, or are they a highly profitable enterprise?
Well, what's fascinating here is that the company essentially uses two scoreboards to communicate different types of truth.
Two scoreboards. I like that.
Yeah. You have GAAP, which includes like absolutely every cost associated with running the enterprise. But management argues that GAAP kind of obscures the health of their underlying engine.
Okay, so they just make up their own scoreboard.
Basically, yeah. They create the non-GAAP scoreboard, stripping out expenses they consider to be non-cash or one-time historical anomalies.
Right, and looking at the reconciliation tables in their appendix, those stripped out expenses are just staggering.
No, they are massive.
Yeah, like in Q1 alone, they backed out roughly $20 million in stock-based compensation across their research and development and their sales teams. They also excluded performance-based equity bonuses, which their filing specifically notes are settled in shares of common stock, not cash.
Right, that's a key detail.
And on top of that, there is another $6.5 million in acquisition and integration costs, largely tied to their terminated merger with Silicon Motion.
Right, so from an operations standpoint, paying an engineer in stock rather than cash doesn't actually drain the company's bank account today.
Okay.
It keeps their day-to-day cash flow healthy, allowing them to fund the design of next-generation chips. That's really the rationale for removing it from the non-GAAP numbers.
Makes sense.
And the same logic applies to the $6.5 million tied to the canceled Silicon Motion merger. When a massive merger fails, you spend millions untangling legal frameworks, paying advisory fees, all that stuff.
Right. Lawyer fees add up fast.
Exactly. Management views that as a historical distraction, basically money burned on a dead deal, not an ongoing cost of designing semiconductors.
I mean, I understand the rationale, but I really have to push back here.
Sure.
Isn't relying on non-GAAP kind of like bragging that you kept your household spending incredibly low this month, but only because you paid your babysitter and your plumber by, like, giving them equity in your house?
Wow, that's a really good way to put it.
Right. Because it doesn't drain your checking account today, sure, but it severely dilutes your ownership of the property. Paying your top-tier engineering talent is a very real, recurring expense. It is not a one-time anomaly.
No, you're right. It's a permanent expense.
So as an investor, Or even just an observer trying to understand the health of this company, which scoreboard actually matters?
Well, you really need both to see the three-dimensional picture. Your analogy hits the nail on the head regarding dilution, definitely.
Yeah.
The DAP loss tells you the true, fully burdened cost of the enterprise, including the very real cost of slicing the pie thinner for existing shareholders.
Right.
But the non-GAAP profit is a much better indicator of the company's trajectory and the viability of their actual product.
How so?
Well, if a company's core operations are unprofitable, meaning it costs them more in raw materials and fab time to make a chip than they can sell it for, that is a fatal flaw. You can't survive that.
Right, you're just losing money on every unit.
Exactly. But MaxLinear's non-GAAP gross margin is nearly 60%. And their non-GAAP operating margin is almost 16%.
Oh, wow.
Yeah, so that proves their underlying business model, the actual manufacturing and selling of chips, is highly profitable. They are just utilizing their equity to aggressively fund their talent pool right now.
Okay, so they're essentially using their own company stock to fund a massive R&D budget.
Exactly.
The question then is, what exactly are those engineers building that justifies burning all that equity?
That is the big question.
Because to find out, we have to look past the top-line revenue, which reveals a pretty dramatic internal pivot.
Yeah, the entire growth narrative of this company has completely shifted gears toward the data center.
Right, and in the business highlights, there's a statistic that explains everything.
Yeah.
MaxLinear breaks their revenue into categories. Their infrastructure category grew 35% just since the last quarter, and an incredible 136% over Q1 of 2025.
That's wild.
Yeah, infrastructure is now officially their largest revenue category, overtaking everything else.
And we can trace that infrastructure surge directly to high-speed optical interconnects. This is the physical layer of the AI revolution.
Okay, break that down for me.
So when you hear about hyperscale data centers building these massive AI supercomputers, you have to realize that a single AI model does not run on one processor.
Right.
It requires tens of thousands of GPUs working together simultaneously. And to coordinate that effort, those GPUs have to share massive data sets constantly.
Like nonstop chatter between the chips.
Exactly. And traditional copper wires simply cannot carry that much data at that speed over the distance of a massive server farm without the signal completely degrading.
The resistance is just too high, right?
Right. So the industry uses light. They use fiber optic cables. But here is the disconnect. The GPUs themselves process data electrically. They need extremely sophisticated chips to act as translators.
Ah, so translating electricity to light and back again.
Exactly. And the specific products MaxLinear showcased at the OFC 2026 conference are those exact translators. They highlighted their 1.6 terabit PHY chipset, which includes the Rushmore 200G per lane PM4 DSP.
Okay, alphabet soup there. What does a DSP actually do?
Right, a digital signal processor. To understand it, imagine data as a strobe light. A traditional signal just flashes on and off to represent ones and zeros.
Okay, simple enough.
But PM4 technology essentially creates 4 different levels of brightness, so it packs twice as much data into the exact same flash of light.
Whoa, that's clever.
Yeah. So Rushmore takes the electrical signal from the server, compresses it using PM4, and preps it for the fiber optic cable.
And then on the other end of that cable, you have the Washington TIA.
Yes, exactly.
And TIA stands for transimpedance amplifier, right?
That's the one.
So if Rushmore is the flashlight, the Washington TIA is kind of like the ultra-sensitive retina.
I love that analogy, yes.
It catches those incredibly fast, subtle variations of light and translates the photons back into an electrical voltage the computers can read perfectly, billions of times a second.
Exactly. It's mind-blowing speed.
Yeah.
And they also announced Annapurna, which is a high-performance scale-up retimer.
Retimer.
Yeah, so as data travels across the sprawling racks of a data center, the signal gets noisy and garbled. Annapurna acts like a pristine game of telephone.
Oh, I see.
It catches a degraded whisper, cleans it up entirely, and shouts it perfectly clearly to the next server rack at 1.6 terabits per second.
So that is insane.
It is. And if we connect this to the bigger picture, these specific highly technical components, the DSPs, the TIAs, the retimers, they are the absolute critical bottleneck for AI.
Because if you can't move the data, the AI is useless.
Right. You can buy all the cutting-edge GPUs in the world, but if your optical plumbing can't move the data fast enough, your billion-dollar supercomputer is essentially sitting in traffic. MaxLinear is positioning itself to own the toll roads.
That's brilliant. But here's where it gets really interesting, though. While they are clearly going all in on this optical data center plumbing, The Q1 highlights also showcase momentum for their Sierra single-chip radio SoC.
Right, the wireless stuff.
Yeah. They are deploying these with multiple commercially available O-RAN units at the Mobile World Congress in Barcelona. And O-RAN stands for Open Radio Access Network, which is basically an initiative to standardize cell tower hardware so telecom carriers aren't, locked into one vendor forever.
Right, giving carriers more flexibility.
Exactly. But are they spreading themselves too thin here? Like trying to build wireless radio chips for telecommunications alongside optical chips for AI data centers? Or is there a unified master plan here?
It's a great question, because designing chips for 5G base stations and designing optical retimers for AI data centers, they require entirely different engineering disciplines.
Completely different physics almost.
Yeah, exactly. However, from management's perspective, both fall under that highly lucrative infrastructure umbrella we talked about. They are both highly complex, high-margin enterprise products.
Right.
The telecom radio market provides steady, critical infrastructure revenue. Cell towers are constantly being upgraded, but the optical interconnects provide the explosive exponential growth tied to the AI boom.
I see.
So the radio chips provide the stability, the optical chips provide the rocket fuel.
That makes total sense.
Yeah.
Having cutting-edge optical and radio tech is great, but, in the hardware world, execution requires validation.
Absolutely.
We need massive buyers to prove the tech actually works at scale. And CEO Kishore Siendripu claimed in the press release that Q1 marks the start of a multi-year growth phase.
Yeah, those are bold words for an industry known for vicious boom and bust cycles.
Very bold. The market demands concrete proof to back up that kind of optimism. And MaxLinear actually offered a very specific multi-layered piece of evidence.
It did, yeah.
They announced their first PON design win at a U.S. hyperscale data center customer.
Right, the PON deal.
And PON stands for Passive Optical Network. Unlike traditional networks that need active power to route data, a PON uses unpowered glass prisms to split light and route it efficiently. It's a highly efficient way to manage data center architecture.
It's super elegant engineering.
And this deal was routed through a Tier 1 U.S. OEM partner, right? An original equipment manufacturer. Meaning, MaxLinear doesn't sell directly to the hyperscaler. They sell their chips to the massive company building the actual server racks.
Right.
But the revenue for this specific design is expected to begin ramping up in Q4 of 2026. Furthermore, they issued aggressive Q2 2026 guidance, projecting revenue between $160 million and $170 million. The CEO literally called this expected Q2 jump a step function increase in revenues.
Right, and a step function increase implies a permanent move to a new, much higher baseline of revenue, not just like a seasonal spike.
It's a permanent leveling up.
Exactly. But if you dig into the financial documents, there is a hidden financial maneuver that validates this growth projection in a very tangible way.
Oh, the credit agreement.
Yes. MaxLinear amended their existing credit agreement with Wells Fargo and other lenders. They extended the maturity date of their revolving credit facility to March 2028, and they increased the available funds by $30 million, bringing the total facility to $130 million.
Right, I noticed that in the SEC filing.
Right.
But the release explicitly states that the facility is currently undrawn. Like they haven't borrowed a dime of that money.
Right.
And they already had over $61 million in cash and cash equivalents just sitting on the balance sheet at the end of Q1. So if they have millions in the bank, why go through the trouble of expanding a credit line right now?
Because it is a textbook indicator of a company preparing for the massive working capital needs of a production ramp-up.
Oh, because hardware is so expensive up front.
Exactly. In the hardware business, you have to buy the raw materials, secure the supply chain, and pay the manufacturers to physically build your chips long before you actually deliver them to the OEM and get paid.
Right. The cash conversion cycle is brutal.
It is. So expanding that credit facility provides a massive safety net to fund the upfront costs of a massive order without draining their existing cash reserves. It really proves they're putting the financial architecture in place to handle that physical step function increase in production.
Okay, so what does this all mean for the timeline, though? Because if we lay the statements out side by side, there is a chronological gap.
What do you mean?
Well, they announced the massive PON design at the U.S. hyperscale data center, but explicitly stated it doesn't begin ramping up until Q4 of 2026.
Right.
Yet the CEO expects this major step function increase in revenue immediately, like in Q2. So if the PON contract money isn't hitting until the end of the year, where is that immediate Q2 surge coming from?
Okay. The immediate Q2 surge to the 160 million to 170 million range that is being driven by the products that are already validated and shipping today.
Okay.
It is driven by the production ramps of the optical data center products we discussed earlier, the Rushmore DSPs and Washington TIAs at multiple hyperscale customers. That is what is moving the needle right now.
Got it. So what does the Peons deal do?
The Peon design win ramping in Q4 serves a totally different purpose. It represents future locked-in growth. It basically acts as an insurance policy, proving to investors that the major players are committing to MaxLinear's technology long-term.
It guarantees the baseline.
Right. It guarantees that the step function baseline holds strong into the following year.
Which brings us to the ultimate reality check. Predicting massive surges in Q2 and Q4 is incredibly exciting, but in hardware, a blueprint is just a piece of paper until it's actually silicon. To understand if MaxLinear can actually pull this off, we have to look at how they physically build their products and the specific risks that threaten their entire model. And for that, we turn to the legal disclosures in their SEC Form 10-Q filing.
Yeah, the 10Q is where all the marketing optimism just gets stripped away.
Totally.
Because companies are legally obligated to disclose the mechanical vulnerabilities of their business.
And it is a pretty sobering read. The filing describes MaxLinear as a fabless integrated circuit design company. Under their risk factors, they outline the cyclical nature of the semiconductor industry, the severe danger of excess inventory in the channel, international geopolitical conflicts, escalating trade wars, and, the potential payment of damages from that terminated Silicon Motion merger.
Yeah, to understand how those risks directly threaten their AI ambitions, we really have to unpack the term fabless.
Okay, what does that mean exactly?
So MaxLinear designs the chips, they create the intellectual property, the microscopic architecture, the complex PAM4 algorithms.
The blueprint.
Right, the blueprints. But they do not own the multi-billion-dollar fabrication plants, or fabs, required to manufacture the physical silicon. They rely entirely on third-party foundries, primarily located overseas, to actually build their products.
Oh, wow.
Yeah, and this raises an important question. If you do not control your own manufacturing lines, how do you guarantee you can meet this massive step function hyperscale demand without destroying your own company in the process?
It sounds like being a world-class chef who has designed an incredible Michelin star menu. You have the recipes, and your dining room is packed with wealthy customers ready to order. But your kitchen is located on another continent, and it's run by a completely different company.
That is exactly what it's like.
Right. If you overestimate demand and order way too much expensive Wagyu beef, it spoils, and you eat the massive loss. But if you underestimate demand, or if, say, geopolitical tensions cause shipping lanes to close, your local diners sit at empty tables, get frustrated, and leave to eat at your competitor's restaurant.
That captures the incredible tension of supply chain management perfectly. In the fabless model, excess inventory is literally deadly. Chips age like milk, not wine.
Oh, that's a good point.
Yeah, if a hyperscaler suddenly changes their architecture next year, those millions of dollars of perfectly manufactured chips become worthless sand. Your margins are instantly destroyed.
Wow.
Conversely, the geopolitical risks mentioned in the 10Q, trade wars, export controls, military conflicts, they mean that your overseas kitchen might suddenly be legally prohibited from sending you your products. Tariffs might make those chips twice as expensive overnight.
So it's a huge trade-off.
It is. The fabless model allows MaxLinear to be incredibly agile and focus purely on innovation, avoiding the billions required to build a physical plant. But it essentially outsources the physical risk of their entire business to a highly fragile global supply chain.
And it really contextualizes the cost of that failed Silicon Motion merger we talked about. If you are operating on a high wire, trying to perfectly time your overseas inventory with this exploding AI demand, the last thing you need is millions of dollars and countless executive hours draining away to deal with the legal fallout of a terminated deal.
Oh, absolutely. Every dollar spent on lawyers is a dollar not spent on the next generation of optical research.
It completely reframes how you look at a supposedly dry financial report, honestly.
It really does.
We have taken a stack of 2026 earnings documents and uncovered this dramatic story of a fabless semiconductor company navigating the chaotic, highly lucrative waters of the data center boom. Reading this SEC filings isn't just about looking to see if the final profit or loss number is red or black. It is about finding the hidden trends like a 196% spike in infrastructure revenue that tell you exactly where the entire tech world is heading.
Exactly.
Because the trillion-dollar AI revolution is entirely dependent on companies building the physical plumbing to handle the data.
Which leaves us with a pretty profound reality to consider.
What's that?
We are so conditioned to think of artificial intelligence as this limitless, invisible software. We interact with algorithms that feel like pure magic. But companies like MaxLinear prove that the future of this magic is entirely bottlenecked by intense physical constraints.
Right.
The entire AI revolution is currently held hostage by the laws of physics specifically. How fast we can push light through glass using scale-up retimers, and how efficiently ships can move physical bricks of silicon across the Pacific Ocean. It really challenges us to ask what happens to the exponential growth of software if the physical laws governing these optical chips finally reach their absolute unyielding limits.
That is a fascinating thought to hold on to. The limitless cloud is bound by the laws of physics, and eventually, physics always demands its due. To you, the learner, thank you for joining us as we decoded the alien language of earnings reports. Keep looking for the hidden stories in the data, and we will catch you on the next deep dive.